cryptocurrency market manipulations and their impact on small investors. In recent years, the cryptocurrency market has exploded in popularity, attracting millions of investors worldwide with promises of astronomical returns and financial freedom. However, beneath the surface of this digital gold rush lies a complex and often treacherous landscape, rife with manipulation and schemes that can devastate unsuspecting investors, particularly those with limited resources and experience. This essay delves into the world of cryptocurrency market manipulations, exploring their various forms, the actors behind them, and most importantly, their profound impact on small investors who often find themselves at the mercy of these unethical practices. Understanding cryptocurrency market manipulation. Market manipulation in the cryptocurrency space refers to deliberate attempts to interfere with the free and fair operation of the market. These actions are designed to create artificial, false, or misleading appearances with respect to the price of, or market for, a cryptocurrency. While manipulation exists in traditional financial markets, the cryptocurrency sector is particularly vulnerable due to its relative infancy, lack of comprehensive regulation, and the pseudonymous nature of transactions. Common forms of manipulation: pump and dump schemes. This classic manipulation tactic has found new life in the crypto world. Orchestrators of these schemes artificially inflate the price of a cryptocurrency through coordinated buying or spreading misleading positive information. Once the price has risen significantly, they sell their holdings, causing the price to crash and leaving unwitting investors with significant losses. Wash trading. This involves creating artificial trading activity by simultaneously buying and selling the same cryptocurrency. The goal is to create an illusion of market activity, potentially attracting other investors who believe they're seeing genuine interest in the asset. Spoofing and layering. These techniques involve placing large orders with no intention of executing them. The goal is to create a false impression of supply or demand, manipulating other traders into buying or selling based on this artificial market pressure. Front-running. In this practice, an entity with advanced knowledge of pending orders uses that information to place their own orders first, profiting from the subsequent price movement. Insider trading. While not unique to cryptocurrencies, insider trading is particularly problematic in this space due to the lack of clear regulations and the close-knit nature of many crypto projects. FUD and FOMO manipulation, spreading fear, uncertainty, and doubt, FUD, or creating artificial fear of missing out, FOMO, through social media, news outlets, or other channels can significantly impact crypto prices. The actors behind market manipulation. Understanding who perpetrates these manipulative practices is crucial to grasping their impact and devising potential solutions. Whales. These are individuals or entities that hold large amounts of a particular cryptocurrency. Their substantial holdings allow them to move markets through large buy or sell orders. Trading groups and pump and dump schemes. Organized groups, often operating through private messaging platforms, coordinate buying and selling activities to manipulate prices. Exchanges. Some cryptocurrency exchanges have been accused of engaging in or facilitating manipulative practices, such as wash trading, to inflate their reported trading volumes. Project insiders. Founders, developers, or early investors in cryptocurrency projects may use their insider knowledge to manipulate markets for personal gain. Influencers and public figures. Celebrities and social media influencers can significantly impact crypto prices through their endorsements or criticisms, sometimes as part of coordinated manipulation schemes. Bots and algorithmic traders. Automated trading programs can be used to execute complex manipulation strategies at speeds and scales impossible for human traders. The impact on small investors. Small investors, often referred to as retail investors, are particularly vulnerable to the effects of market manipulation in the cryptocurrency space. These individuals typically have limited capital, less sophisticated trading tools, and less access to information compared to institutional or professional traders. The impact of manipulation on these investors can be devastating and far-reaching. 1. Financial losses. The most immediate and obvious impact of market manipulation on small investors is financial loss. Pump and dump schemes, for example, can cause inexperienced investors to buy into a cryptocurrency at artificially inflated prices, only to see their investment plummet in value when the manipulators sell off their holdings. These losses can be substantial, sometimes wiping out entire savings or investment portfolios. 2. Erosion of trust. Repeated exposure to manipulative practices can erode small investors' trust in the cryptocurrency market as a whole. This loss of confidence can lead to reduced participation in the market, potentially stunting the growth and adoption of legitimate blockchain and cryptocurrency projects. 3. Psychological impact. The volatile nature of cryptocurrency markets, exacerbated by manipulation, can take a significant psychological toll on small investors. The stress of watching investments rapidly gain or lose value, often due to factors beyond their control or understanding, can lead to anxiety, depression, and other mental health issues. 4. Misallocation of resources. Market manipulation can distort the price discovery mechanism, leading small investors to misallocate their limited resources. They may invest in overvalued assets due to artificial price inflation, or overlook genuinely promising projects that haven't been subject to manipulative pumping. 5. Regulatory backlash. As manipulative practices come to light, they often prompt increased regulatory scrutiny. While regulation can be beneficial in curbing abuses, overly stringent or poorly crafted regulations in response to manipulation can inadvertently harm small investors by limiting their access to cryptocurrency markets or increasing compliance costs. 6. Opportunity costs. Time and resources spent navigating manipulated markets represent significant opportunity costs for small investors. Instead of focusing on long-term investment strategies or learning about blockchain technology, they may find themselves constantly trying to avoid the next scam or recovering from losses. 7. Uneven playing field. Market manipulation exacerbates the already uneven playing field between small investors and larger, more sophisticated market participants. This inequality can discourage small investors from participating in the market, potentially missing out on legitimate opportunities for financial growth. Case studies of manipulation and their effects. To better understand the real-world impact of cryptocurrency market manipulation on small investors, let's examine a few notable case studies. The BitConnect scandal. BitConnect, launched in 2016, promised investors high returns through a lending program and a proprietary trading bot. Despite red flags, many small investors were drawn in by aggressive marketing and promises of easy wealth. In January 2018, BitConnect abruptly shut down its lending and exchange platform, causing the price of its token to crash by over 90% in hours. Thousands of small investors lost their life savings, with total losses estimated at $2.5 billion. Lesson: this case highlights how pyramid schemes and fraudulent projects can masquerade as legitimate cryptocurrency investments, exploiting the complexity of the technology and the promise of high returns to manipulate small investors. The 2017 Bitcoin Cash Pump. In November 2017, the price of Bitcoin Cash, BCH, suddenly spiked from around $300 to nearly $2,500 in just 2 days, only to crash back down shortly after. This extreme volatility was largely attributed to coordinated buying by a small group of large holders, combined with the announcement that BCH would be added to major exchanges. Many small investors, caught up in the FOMO, bought at the peak only to see their investments rapidly depreciate. Lesson: this incident demonstrates how even established cryptocurrencies can be subject to manipulation, and how quickly small investors can suffer losses when caught in the crossfire of whale activity and exchange listings. The Dogecoin roller coaster, Dogecoin, originally created as a joke, saw its value skyrocket in 2021, largely driven by social media hype and endorsements from high-profile figures like Elon Musk. The price surged from less than a cent to over 70 cents before crashing back down. While not a traditional manipulation in the sense of a coordinated scheme, this case shows how social media influence and celebrity endorsements can create artificial demand and volatility, leaving many small investors holding the bag when the hype subsides. Lesson: this case underscores the power of social media and public figures in moving cryptocurrency markets, and the risks small investors face when investing based on hype rather than fundamentals. Mechanisms of manipulation: a deeper dive. To fully appreciate the challenges facing small investors, it's crucial to understand the intricacies of how various manipulation techniques work in the cryptocurrency market. 1. Pump and dump schemes in detail. Pump and dump schemes in the crypto world often follow a predictable pattern. Accumulation. Manipulators quietly accumulate a large amount of a low-cap cryptocurrency over time. Promotion. They start aggressively promoting the coin through social media, chat groups, and even paid advertisements, often using false or misleading information. The pump. As buzz builds, more investors buy in, driving up the price rapidly. The dump. Once the price reaches a target, the manipulators sell their holdings en masse, crashing the price. Small investors, attracted by the rapid price increase and afraid of missing out, often buy near the peak and are left with worthless tokens when the price collapses. 2. The mechanics of wash trading. Wash trading involves simultaneously buying and selling the same asset to create artificial volume. In cryptocurrency markets, this can be done through self-trading. An entity trades with itself using multiple accounts. Collusion. Multiple entities agree to trade back and forth with each other. Automated bots. Programs that execute rapid buy and sell orders. The artificial volume created by wash trading can fool investors into thinking a cryptocurrency is more popular or liquid than it actually is, leading them to invest based on false premises. 3. Spoofing and layering techniques. These manipulation techniques involve placing and canceling large orders to create a false impression of market depth. Spoofing. Placing a large order on one side of the order book with no intention of executing it, then quickly canceling it. Layering. Placing multiple orders at different prices to create the illusion of increased supply or demand. These practices can trick algorithmic trading systems and less experienced traders into making disadvantageous trades based on the artificial market pressure. 4. The intricacies of front-running. Front-running in crypto often occurs in decentralized exchanges, DEXs, where transactions are visible in the mempool before they're confirmed. Manipulators can monitor the mempool for large pending transactions, place their own transaction with a higher gas fee to ensure it's processed first, profit from the price movement caused by the large transaction. This practice disadvantages regular investors who may receive worse prices on their trades due to the front-runner's interference. The role of technology in manipulation. The unique technological aspects of cryptocurrencies and blockchain networks create both vulnerabilities and opportunities for market manipulation. 1. Blockchain transparency. While blockchain transparency is often touted as a feature, it can also be exploited by manipulators. The ability to see large transactions or wallet movements can be used to create FUD or FOMO, influencing market sentiment. 2. Smart contract vulnerabilities. Smart contracts, which are self-executing contracts with the terms directly written into code, can be exploited if they contain vulnerabilities. Manipulators might use these vulnerabilities to drain funds from decentralized finance, DeFi protocols, causing market panic and price crashes. 3. High-frequency trading bots. Advanced trading bots can execute complex manipulation strategies at speeds impossible for human traders. These bots can take advantage of market inefficiencies and exploit the slower reaction times of retail investors. 4. Social media and sentiment analysis. Manipulators use sophisticated tools to analyze social media sentiment and spread misinformation at scale. This can include coordinated campaigns using bot networks to artificially inflate the perceived popularity of a cryptocurrency. Regulatory landscape and challenges. The regulatory environment surrounding cryptocurrencies plays a significant role in both enabling manipulation and in efforts to combat it. 1. Jurisdictional issues. The global, decentralized nature of cryptocurrencies makes it challenging for any single regulatory body to effectively oversee the market. Manipulators can often operate across borders, making enforcement difficult. 2. Lack of clear definitions. Many jurisdictions struggle with how to classify and regulate cryptocurrencies, leading to regulatory gaps that can be exploited by bad actors. 3. Resource constraints. Regulatory bodies often lack the technical expertise and resources to effectively monitor and investigate manipulation in the fast-moving, technologically complex crypto markets. 4. Balancing innovation and protection. Regulators face the challenge of protecting investors without stifling innovation in the blockchain and cryptocurrency space. Overly restrictive regulations could drive innovation offshore or underground. The psychological aspect of manipulation. Understanding. The psychological factors that make small investors vulnerable to manipulation is crucial. 1. Fear of missing out, FOMO. The rapid price increases often seen in crypto markets can create intense FOMO, leading investors to make impulsive decisions based on emotion rather than sound analysis. 2. Confirmation bias. Investors tend to seek out information that confirms their existing beliefs about an investment, making them more susceptible to manipulative tactics that align with their hopes. 3. Dunning-Kruger effect. Some inexperienced investors may overestimate their understanding of the complex crypto market, leading them to make overconfident decisions and fall prey to sophisticated manipulation schemes. 4. Sunk cost fallacy. Investors who have lost money due to manipulation may be reluctant to cut their losses, instead throwing good money after bad in the hope of recouping their initial investment. Protecting small investors. Potential solutions. Addressing the issue of market manipulation and protecting small investors requires a multifaceted approach. 1. Enhanced regulatory framework. Developing clear, comprehensive regulations specifically tailored to the cryptocurrency market could help deter manipulative practices. This might include clearer definitions of what constitutes manipulation in crypto markets, stricter penalties for individuals and entities engaged in manipulative activities, enhanced reporting requirements for cryptocurrency exchanges and projects. 2. Improved market surveillance. Implementing advanced market surveillance systems capable of detecting patterns indicative of manipulation in real time could help regulatory bodies and exchanges respond more quickly to potential abuses. 3. Education and awareness. Expanding educational initiatives to help small investors understand the risks and recognize signs of manipulation is crucial. This could include collaborative efforts between regulators, exchanges, and crypto projects to provide accessible educational resources, incorporating cryptocurrency and blockchain education into financial literacy programs. 4. Technological solutions. Leveraging blockchain technology itself to create more transparent and manipulation-resistant markets. Implementing decentralized identity solutions to reduce anonymous manipulation. Developing smart contract standards that include built-in protections against common manipulation tactics. 5. Exchange accountability. Holding cryptocurrency exchanges to higher standards of accountability and transparency, requiring regular third-party audits of exchange practices and volumes. Implementing stricter listing requirements to reduce the prevalence of easily manipulated low-cap cryptocurrencies. 6. Community vigilance. Empowering the cryptocurrency community to play a role in identifying and reporting suspicious activities, creating decentralized reporting mechanisms for suspected manipulation, encouraging responsible disclosure of vulnerabilities in cryptocurrency projects and exchanges. The future of cryptocurrency markets. As the cryptocurrency market matures, it's likely to see both evolving forms of manipulation and more sophisticated methods of prevention and detection. Key trends to watch include: 1. Institutional involvement. The increasing participation of institutional investors may bring greater scrutiny and demand for market integrity, potentially leading to reduced manipulation over time. 2. Regulatory evolution. As regulators gain more experience with cryptocurrency markets, we can expect more nuanced and effective regulatory frameworks to emerge. 3. Technological advancements. Continued advancements in blockchain technology may lead to the development of more inherently manipulation-resistant cryptocurrency systems. 4. Market maturation. As the market matures and becomes more efficient, some forms of manipulation may become less effective or profitable, naturally reducing their occurrence. Conclusion. The issue of market manipulation in cryptocurrency markets and its impact on small investors is complex and multifaceted. While the potential for high returns continues to attract investors to the crypto space, the risks posed by manipulative practices cannot be ignored. Small investors, in particular, bear the brunt of these unethical activities, often suffering significant financial and psychological harm. Addressing this challenge requires a concerted effort from all stakeholders in the cryptocurrency ecosystem: regulators, exchanges, project developers, and investors themselves. Enhanced regulation, improved technology, better education, and community vigilance all have roles to play in creating a fairer, more transparent cryptocurrency market. As the market continues to evolve, it's crucial that the protection of small investors remains a priority. By fostering an environment of integrity and transparency, the cryptocurrency industry can work towards fulfilling its promise of democratizing finance and creating a more inclusive global financial system. Only then can the true potential of blockchain technology and cryptocurrencies be realized, benefiting not just a select few, but the broader global community of investors and users.